Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from the market site in Times Square with David Greenberg with BlackRock. We're going to focus on how quantitative research has evolved as well as model portfolios. David, thank you so much for joining us here today. Now, quantitative analytics really has changed the research landscape, that's for sure.
That is absolutely true. Historically, it's been very much focused on the institutional investors, where we've used a lot of our quantitative analytics, sort of using, I work at BlackRock Solutions as part of the Aladdin business, where we sort of take a bottom-up view of portfolios and looking at holdings of bonds, stocks, and all the risk factors that could drive individual portfolios. And those were only available to the elite, to the institutional investors. But now the average investor is starting to get access through wealth managers and so financial advisors. And financial advisors need to offer more services than they ever have before. They've become more sophisticated. Especially most of them now have CFAs and they're chartered. And so BlackRock has teamed up with Morgan Stanley Wealth Advisory, UBS Wealth Advisory. So you have tens of thousands of financial advisors now giving the best-in-class quantitative financial analytics to retail investors. So that's part of the change of bringing technology to the end user to analyze portfolios.
It's really quite incredible how research and access has been democratized.
Yes,
I mean, even
absolutely.
10, 15 years ago, it would have been unthinkable. So it's really quite incredible to see how the industry has evolved. Now, tell us more about model portfolios. What are they and how are advisors using them?
So, I mean, model portfolios, you can think of them as breaking things down into their constituent parts. It's sort of like you have ingredients for food, for a restaurant, and so you have ingredients for portfolios. So the model portfolios can be based on factors. So factor investing is a big part of model portfolios. So value, momentum are factors, quality, ESG factors. So these are ways that you can get pure exposure to, and that's the way that we're advocating that both institutional investors and retail investors think about building their portfolios, is through these model portfolios. They could be ETFs, they don't have to be, that's just one vehicle. And then you those are the building blocks that you use to construct your exposure. So you have your desired target exposure to, again, value, momentum, let's say interest rate risk. So we think of factors as things that exist that are drivers of portfolio returns. They command a risk premium, but they have certain risk associated with them. And that's what these model portfolios are assemblages of different factors.
Right.
And so we have ways of constructing these model portfolios and selling them to clients for lower fees.
So it sounds like it keeps investors diversified and invested.
Diversified, invested.
Right, so you're not playing timing the market because you're constantly shifting your exposure.
Exactly. It's saying, no, it's more about portfolio construction, asset allocation. It's not about stock picking. You know, that's a high turnover, high fee, and so we're moving more towards a world of where investors are looking for the longer horizon and having these model portfolios which will track these long-term risk premia and doing it for the most efficient, cost-efficient way possible.
Well, that's encouraging. We like long-termism in the market, don't we?
Yes, absolutely.
All right, thank you so much, David, for joining us at MarketSite.
You're welcome.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.